All right, let's just jump right in. Every single growing business eventually hits the same wall. You know you need better, bigger, or just more advanced equipment to really scale up. But how do you get it without breaking the bank? That is the million-dollar question. And today, we're going to break down the answer.
This isn't just a numbers question. It's a huge strategic one. The decision you make right here can impact your cash flow, your taxes, and your ability to stay ahead of the competition for years. It's really all about finding the right tools to grow without tying up every last cent of your capital.
And this image, well, it just illustrates the whole thing perfectly. Think about it like this. Every piece of equipment you need is a pie. The real question is, how do you want to slice it? Do you want to own the entire thing? Or are you cool with just paying for the slice you need right now?
So here we are at a fork in the road, and there are basically two main paths you can take to get that equipment you need. Let's lay them both out nice and clear.
Okay, on one side you've got leasing. You can just think of it as renting, really. It's super flexible, your upfront cost is way lower, and the payments are just a regular operating expense. But on the other side, there's buying. This path is all about ownership. You're building equity, you have total freedom to do whatever you want with it, and it can definitely save you money in the long run. Two very, very different strategies for the exact same goal.
Let's start by heading down that first path, the leasing route. We're going to explore what it is, how it actually works, and figure out when it makes the most sense for a business.
So at its core, equipment leasing is pretty simple. It's just a contract to rent something for a set amount of time. You make your regular payments, but, and this is key, when that contract is up, you don't own a thing. It's all about access, not ownership.
Now, what's really fascinating here is the trade-off. You see it, right? The pros are all about flexibility and keeping cash in your pocket. Little or no down payment, easy to upgrade your tech, and hey, you might even get a tax deduction. But the cons? Well, it can cost more over time, you build absolutely zero equity, and you're pretty much locked into whatever the contract says.
And just to make it interesting, it gets a little more complicated. An operating lease? That's your basic rental. But a finance lease, sometimes called a capital lease, gets treated more like a purchase on your books. And then you've got lease to own, which, just like it sounds, gives you the option to actually buy the equipment when your term is up. Each one has totally different consequences for your accounting and your long-term plans.
All right, let's back up and head down that other path, the ownership route. This is for all the businesses out there who are thinking about the long game.
An equipment loan is, well, it's exactly what it sounds like. It's a loan you take out to buy a piece of equipment, and the cool part is the equipment itself acts as the collateral. You make that final payment, and boom, that asset is 100% yours.
So, the whole deal with ownership really boils down to this: control versus responsibility. On one hand, you own it, you can change it, you can sell it. Plus, you get those nice tax benefits from depreciation. But, and it's a big but, the cons are serious. We're talking high upfront costs, you're on the hook for all the maintenance, and there's a very real risk you get stuck with old, outdated tech.
Here's a great little rule of thumb. Let's say you're a construction company buying a giant crane that's going to last for decades and hold its value. In that case, buying makes total sense. That asset is a core piece of your business. But if you're buying tech that's going to be a dinosaur in 2 years, yeah, ownership suddenly starts to look more like a liability.
Now listen up, because this is important. Whether you lease or buy, the sticker price is never the final price. We have to talk about the hidden costs, the ones that can sneak up and catch you completely off guard.
I want you to pay close attention to this number, 20 to 50%. That's how much hidden costs can inflate the total expense. This is not a rounding error, folks. It's a massive potential budget breaker that you have to plan for.
So what are these silent budget killers? Well, first, you've got your soft costs, things like delivery, setup, and training. Then you have the fees buried deep in the fine print, origination fees, penalties, and then there's the biggest one of all, the one that really hurts, downtime. Every single hour that equipment isn't running, you're not just paying for repairs, you're literally losing money.
Okay, so given all the risks with the old ways of doing things, a new, much more flexible model is starting to show up. Let's call it the third path. It's called usage-based financing. And the idea is pretty brilliant. Instead of a fixed monthly payment, your payments are tied directly to how much you actually use the equipment. It's a pay-as-you-go model that completely flips the script on financing.
This quote just sums it up perfectly. If your machine spits out 1,000 widgets this month, you pay based on that. If next month is slow and it only makes 100, guess what? Your payment drops. It's financing that actually breathes with the rhythm of your business.
The benefits here are just huge. You basically get rid of that massive upfront investment. Your costs are tied directly to your revenue, which is amazing. It protects your cash flow when things get slow, and it magically turns a giant capital expense into a much more predictable operating expense. For a lot of businesses, this is a total game changer.
So let's bring it all home and make this crystal clear. You choose to lease when you need maximum flexibility, when the tech you're using changes at lightning speed, and, most importantly, when keeping cash on hand is king. On the flip side, you buy when you're playing the long game, for stuff that's durable, core to your business, and builds real, tangible equity in your company.
So, before you sign a single thing, just pause. Ask yourself these 4 critical questions. Number 1, what is our monthly budget really? 2, how long are we actually going to use this thing? 3, how fast is it going to become a museum piece? And finally, the big one, does owning this thing actually fit with our long-term vision? The answers will show you the way.
So there you have it. We've laid out the map, we've shown you the different paths, and we've pointed out the potential roadblocks. The choice between leasing, buying, or maybe one of these new models, it's one of the most important decisions you'll make. So, the only question left is, which path is the right one for you?